This case study comes from some work we did for one of our clients a number of years ago, who was in the process of trying to find something affordable for his company. He had gone to the marketplace over the 15 years and had come to the conclusion each time that he couldn't afford what the companies were asking for premium. I suggested that he look at just giving the employee whatever amount he was going to contribute to the benefit plan. He asked me how that worked, and this presentation is an illustration of what we went over with them. Typical employee with a $45,000 a year salary. That employee gets raises throughout their employment, annually, quarterly, whatever it is. That employee works 37 hours, 48 weeks a year for 1,776 hours a year, which means they have a $25.34 an hour income. This is a survey done by a company called Culpeper in March of 2011. The survey was on the subject of salary increases in Canada. Basically said the salary increases in Canada are projected to rise from 2.26% in 2010 to 2.83% in 2011. That 2.83% represents 72 cents an hour. So for our illustration purposes, let's use 70 cents an hour, which translates to $1,243 in an annual increase. The raise will trigger payroll tax for the employer. So let's look at that now. The employer will have to pay CPP, EI, workers' compensation anywhere from 0 to 13%, depending on what industry that business is. Also, we're illustrating an 8% holiday pay, which is basically for any employees that would qualify for 4 weeks a year, which is the type of employee you really want to put the benefits on. Also, if the company has a payroll of more than $400,000, they have an Ontario health tax premium of 1.95%. So the employer's payroll tax in this illustration is 29.63%. It translates to $371 tax the employer has to pay on this raise. So the $1,243 raise turns out to be $1,612 cost to the employer. Or another way of putting it, so the 70 cent an hour raise that the employer is giving the employee actually costs the employer 87 cents. But there's also a tax effect for the employee. So let's look at what happens to the employee amount. The employee must pay his share of CPP, his share of EI. With a $45,000 annual income, their marginal rate of tax is 31.15, so the employee actually loses 38.52%, or it costs the employer $479. This is a real interesting part, and the thing we want to deal with and make more efficient. The $1,612 cost to the employer actually gives the employee $764, or 47.3% of what it costs the owner. That's the way a raise is treated, or salary is treated. So let's look at what happens if we just basically, if we change the name of what we're giving the employee and call it a health account, and see what the tax treatment is here. The employer cost drops to $1,243, or a savings of $371 to the employer. The employee gets $1,243, or 100% of what it costs the employer, which is a $479 increase in pay to the employee. All this because we're applying Section 248 to the income tax for the employer and employee. For further information, you can contact us at 1-800-507-1781. We would suggest that you can set up an appointment for a go-to-meeting session any day from 9 until 4, and we'd be happy to go over this with you. Thank you.